you have this quote here. You said investing is hard every day. Let's start with that, Raj. What exactly does that mean to you?
So I cast my mind back to the late 90s, just, around the dot com. So I was lucky to be the most junior person at the team at Goldman then in Asia. And, we'd meet one company every month. And so that's effectively 12 companies a year, but it was euphoric. And given there wasn't a lot of companies, you probably ended up doing, more than 50% of the deals, but you had a lot of time to do it. And it was very hard because it was very new. If I cast my mind back, say 3 or 4 years from today, it started to take off again. But you were meeting probably 3 or 4 companies a day, right?
Yeah.
And you've
Mhm.
met hundreds of companies a year. And so you get this knowledge that you've built, but also becomes very difficult because you've met so many companies, and the investor community has just become much larger as well. So supply has increased, demand has increased, and it's still hard, right? Whereas
Yeah.
back then there weren't a lot
Mhm.
of companies, and you do a lot of work and you do a lot of hard work, and you hope it's good work to invest. I think now it's just so much supply and so much demand, it becomes commoditized. So it was hard back then because there wasn't enough. Now it's hard because there's too many. And investing is not, as everyone knows, there's a quantitative aspect, there's a qualitative aspect. You can get both right, you can get one wrong, you can get both wrong. Um, there's no hard and fast rule. You can have a checklist that you check off every time, but you get 99 things right and one thing wrong, and that one thing costs you.
Risk management.
It's very imperfect. It's very imperfect. I suspect it's more qualitative than quantitative. If I accelerate 10 years and I'm out of the industry, I think it'll be qualitative, not quantitative.
100%. Awesome. Well, Raj, let's kick it off with your background. So, take us back to kind of when you started your career at Goldman, and walk us up to where you're at today.
So it was the mid 90s. I graduated out of the University of Sydney in Australia. At that time, I struggled to get a job. My results were fine. I tried management consulting. I got dinged by everyone. I tried a couple of the banks here. I got dinged. I was fortunate to get an interview with Goldman in Hong Kong and got the job in Singapore, and was with the firm for just over 10 years, having experienced Singapore, the US, both East and West Coast, as well as Hong Kong. I was there during the dot com rise and fall, and left the company around the GFC. I had
Hmm.
fantastic experiences starting in research, then investing, doing public private. I was lucky to have met Jack Ma from Alibaba very early, whilst he was still a teacher, and that was an experience that I will always remember, and that's built me to what I am today in terms of being in the sector, being in the segment, meeting people early that end up flourishing, and hopefully you've been part of that journey to help them flourish. Um, I've had the opportunity to be in the same room as Bill Gates. One of the analysts that I worked with, a guy called Rick Sherland, who was very senior at Goldman. He ran that relationship. So I had all these great experiences whilst I was very, very young. And that allowed me to then leverage to other things. So I left the firm, I moved to a client of the firm, then I moved to a family office. I then got the itch in about 2013 to build a technology company myself, just looking around and everyone else was doing it. And it
Hmm.
was an experience that I was very enthusiastic about, but it was 1,312 days of complete mess, product mistakes, marketing mistakes, technology mistakes. But we were lucky to find product market fit. We found investors, sold part of the business, and that precipitated the move back to Australia in 2015. And we launched the current fund, which is called the Alium Fund, in 2016.
Yeah. Let's get into that. So let's start with the name Allium. What does that come from?
So one of my partners was very strong at Latin at school, and we debated lots of different names. Every mountain was taken, every ocean was taken. So we said, we've got to come up with something different. So he said, let's choose allium, and we thought, what does it mean? And he said, different. And we thought, oh, yeah, we want to be different. Like in terms of what we're doing, that sounds fabulous. Let's choose it. So we registered the name, got everything done, and then we go out marketing. And there was an Italian guy that we met in one of our first meetings. He goes, "Why did you choose Allium?" We go, "Well, it's Latin. You know, it's sophisticated. It means different." He goes, "Not in Italian. It means smelly onion." So we ended up sticking with the Latin version, not the Italian version.
Oh yes. So I guess going off that, Raj, like just from being different, obviously the Latin version. Uh, how do you see that playing out in real time from whether it be just your strategy investing or your your career?
So from an investment strategy standpoint, the difference is how we operate. So we're not venture capital whereby we take lots and lots of bets hoping for a couple of wins, nor are we private equity whereby you take majority control transactions and change the business. We kind of sit in between whereby we're hoping managements are a little bit more mature, boards are in place, the product market fit's happened, companies have got traction, um, and we're looking to ideally be passive, but companies and managements will call upon us when and if and when they need us, which happens in many instances, but not all instances. So the difference is we don't make lots of bets and we don't make lots of little bets, or sorry, few bets that are very large. We make a reasonable number of bets, but we're hoping that managements are just more mature, and we will be seen as passive investors that allow companies truly to get growth capital to grow and scale.
Yeah, that's really interesting. I guess from having those conversations and as you mentioned, um, throwing something out of the dartboard, looking at opportunity, if you will. Speaking with founders, what are some interesting things you kind of found as people go through that process and you're having those conversations with due diligence? What do you look for?
What we look for is defined by several factors. And Scarlett, one of the things that I said at the start is, the supply of companies is just so rich these days. There's so many companies, and that's because it's become easier to set up a company. You can incorporate easily, you can find people easily, you can speak to a customer through socials. You don't need to get them on the phone. It's just become very easy. I think what we're looking, not I think, I know what we're looking for. We're looking for people that are a little bit more mature. So we rarely invest in anyone that's in their 20s. It doesn't matter how good their business is, because they'll end up being, highly successful and build great businesses, but it's rare that you find someone in their 20s that's got amazing experience. They've got great vision, but execution can be challenging. We're looking to de-risk on entry. So we're looking for someone that understands what executive management looks like, what it means to go to market, what it means to close a customer, what it means to price, what it means to get increasing margins. Um, I th- One of the other key facets with a leader that we're looking for, given that we invest in technology and innovation, they've got to have nous in that. So if we see someone that has got experience in retail, but they're trying to do a fintech, we get somewhat cautious. So we're looking for someone that's technically competent every time. And some of our best investments have been founders that have got a team of 200 people. They've got success, they've got strategic investment, they've grown well, but the leader's still on the tools, right? He's not doing capital raising the whole time. He's still on the tools and involved in product architecture. That makes a big difference, right? So technical
Mhm.
nous, in our opinion, is probably the most important facet with a leader. Then you get things like authenticity. Is the person authentic? Everyone knows how to market. Great marketers can raise a lot of money. Doesn't mean great marketers can build a great business, right? So we're looking for authenticity. So one of the things that we do is when you've made the decision to invest but you haven't signed the documents, take them out to dinner. And we look at their behavior with the wait staff, right? So you might have had one beer or one
Mhm.
wine, but just how they treat them, how they talk to them is really important, because during capital raising, everyone is always really nice and really responsive. But when you take them out of that zone, you got to test what they're like. So we
Yeah.
do it in that particular way, and it's telling sometimes. A company's been really good to us in meetings and on Zoom calls, and you go to their office, but then you go to the restaurant and they're like really objectionable with people, which kind of indicates that there's a
Yeah,
bit of selfishness there.
right. They're on their best behavior
Yeah,
initially. Yeah,
yeah.
yeah,
Like best behavior is not what we're looking for. We're looking for just good behavior,
that's right.
right? Because we
Through and
often,
through.
often we have a little bit of buyer's remorse with investments, which is inevitable, whereby the companies just don't respond as they did during cap raising. During cap raising, they're on demand, but then once they've taken the money, sometimes they take a couple of days to respond, and you got to nudge them in SMS and WhatsApp and email and Slack. You kind of go, that's not what they were like. Because if they're doing that with us who've given them money, it's probably what they're like with staff. And that's when you get poor morale.
Yeah,
Yeah.
100%. So let's dive into the type of companies you guys invest in. So you mentioned technology focused companies. Are you looking for companies strictly in Australia? Um, and what type of technology?
Yep. In terms of location, anyone that is from Australia or New Zealand based anywhere is within our zone. So we've historically invested in a company based in Singapore. We've done a company in the UK. We've done a couple of companies in Canada. We've done a couple of companies in the United States, but they all have a tentacle back to Australia. So that could be an Australia or New Zealand founder, or they've got a key investor or customer that's based here, because that is a really important thread for us. Because otherwise, you're just an investor with money, is our view. Um, we from a technology standpoint, are reasonably agnostic. So we have been diverse in what we've done. So we've done a crypto exchange, we've done a vertical food farming business, we've done cattle collars, we've done B2B SaaS, we've done autonomous vehicles. Everything for us is idiosyncratic. We're not necessarily looking to play themes. So right now, AI is hot. Everyone's making vertical or horizontal AI investments. They're just pricey, right? So for us, it's great to meet them, but they're expensive, and often they don't have the traction that justifies the valuation. So for us, the idiosyncrasy is around management and the price that you pay. And as I mentioned earlier,
Mhm.
we're not looking for spectacular growth. We're looking for certain growth. I mean, there is no company in this world that is raising capital that doesn't show amazing growth next year and the year after. So for us, it's great. You won't achieve it, right? So what is real? And for us, the onus is internally, like, what do we think they'll achieve? They're not going to do 100% growth next year. Will it be 30%? Will it be 55%? What are we comfortable with? And guess what? Not only will
Mhm.
they be wrong, we'll also be wrong. But you want to be wrong on your numbers, not on their numbers.
Yeah, and it sounds like you have kind of a value aspect as
We
well.
do, which is really hard in technology, right? So to be a value buy, like we are growth at a reasonable price investors. So we are GARP in technology, but
Or
it makes it really difficult, right? So we often can't invest because price just isn't right. And sometimes you just offend people as well when you say, hey, look, what valuation are you expecting? And they might say X, and you go, wow. Okay. And they say, what would you pay? We go, well, we're very sensitive, would be 0.5X. And, they're startled, but that's just what we are. And so when people do take our price, we love it. So we've got one company whose name I can't mention, who's going public soon. We invested in them in 2018. They were trying to raise at a valuation of $85 million pre-money. We invested at 40. Like we said, we think 40 is fair. It'll probably go 500, $600 million now, right? But it, what it suggests is entry is more important, right? They could have said whatever growth they want.
yeah,
What we pay is what we feel comfortable with.
Yeah. Well, to your point, how many of the conversations you've had, maybe it was hundreds before you got to that one opportunity, right?
Yeah, correct.
Yeah. That's just really, like you said, it's all about the buying aspect, the entry point.
Yeah, I think also one of the advantages that we've had in how we operate is sometimes people get surprised that we are so value focused or GARP focused, um, but they see the value in what we can bring because we're not overt about it. So if you go to the Allium website or follow our LinkedIn page, we don't talk about the value we add. But the companies that we've invested in, and we've invested in 70 companies since inception, they will talk about it. they will recommend us to others. And so from a value standpoint, we will be hands off if you want us to be. We don't need to be on the board. We'd like an observer seat. If you don't want us to have that as well, we're okay. If we enter at the right price, we're happy to take more risk. So that's number one. Number two is if they come to us and say, hey, let's say, for instance, we've got an insurance company, InsurTech. If they say, hey, guys, are you able to introduce us to this large global reinsurer based out of Switzerland? We, hella high water, will find a way to get a contact there, either directly or indirectly. So we'll go out of our way to help them. If they say, hey, we're looking for a board member who's got marketing experience, can you help us? We will then mobilize through recruiters that we know or people that we know in the ecosystem. Is there someone that we can suggest? So helping that way passively has been very valuable to the companies, and we find it gratifying, right? So we're helping them, but we don't make it part of our MO when we go in, because I think it freaks people out, right? So no one loves to be sold stuff, because when you're sold stuff, it's always, the chances of disappointing are high. We want to surprise in the value that we can bring. I think every one of the 70 companies would say that we did bring value of some sort.
Yeah.
Yeah. So it's kind of that, what's the word I'm looking for? Yeah, just kind of going in low key, but bringing as much value as you
Yeah.
can. And on that note, kind of talk to us about the types of value. It sounds like relationships is kind of a big aspect of the value for you
Yeah,
guys.
relationships are everything. So whether it's a customer relationship, whether it's a accounting relationship, a banking relationship, an employee relationship, that's what I think is our core competence as a team. All of us are generally somewhat extroverted. I think generally we've all got pretty good experience and connections in the community. We're not a big team. We're less than 10 people, but I think we push our weight such that we might replicate 50 or a 70-person team, because that's what we sell ourselves on. So we don't sell ourselves on modeling your business, to line 1,365 in the Excel sheet, going across to column AQ. We just don't do that, right? We've done that in the past. My partner and I at Goldman, we did that. There is some value to it, but there's also not a lot of value to it. Relationship, and this is, we learned this at Goldman. Goldman's a relationship business, right? You win business through relationships. You grow businesses through relationships. And from an investment hat on now, we're trying to do the same, right? So I'd say 30% of our investments in the new fund that we launched late last year are relationships from the first fund, right? So relationships are hugely valuable. And that personal relationship is critical. I've had situations, post COVID, a founder would come in and say, "Hey, Raj, let's have a meeting." So we come into the office. We go into a room. Then you look outside over the canopy. We're not far from the Harbour Bridge where we walk to, or the Opera House, and we go for a walk. And he'll say, "Hey, I want to get your advice. I'm about to have my first child. You've got 4 kids. How was it? How did you manage business?" Those relationships and that discussion is so much more valuable than discussing DCF or a CAC or an LTV. Because, when they have a problem, they end up calling you, right? In business, they'll say, "Hey, Raj, we've struck this with an employee. What should we do? We've struck this with a customer. What we should do?" So I think, sometimes people will say crossing that chasm to build a personal relationship can be fraught with danger. We kind of lean into it.
Yeah, that's really interesting insight, Raj. I'm curious too. We talked about early on about just all the noise and how many conversations you're having it. Much more volume today. How do you kind of distill and or vet out that and get through the noise and have those dynamic relationships? Obviously, it's not everybody is that way, but as you kind of uncover the rocks, you look at opportunity and trying to kind of connect with folks. It can be obviously in 2025. There's a lot of things happening, but I'm just curious how you approach that going forward.
It kind of happens, Skylar, more organically.
Mm-hmm.
So one thing I think we do, which kind of helps the organic side, is you'll share a little bit about yourself, right? So either at a first meeting or the 9th meeting or post investment, once you're willing to share, they're willing to share. right? So whether it's around sport or whether it's around family or whether it's around holiday or whether it's around another company or a conference you went to, but once you start sharing, it kind of it comes back to you. So I feel that, once you start undressing yourself, the other person also starts to undress themselves a little bit. No one gets nude, everyone's clothed. But I think it's important to, um, I think it's very critical to ensure that you're human as well. Even though there's that investor investee relationship, that relationship of I'm just like you. We follow the same cricket team or rugby team or basketball team. Or hey, we both went for a hike around Cradle Mountain in Tasmania. Those things end up being really valuable that help that next step.
Yeah.
And it doesn't happen. It doesn't happen every day, right? It happens occasionally, but all it takes is one of those to happen. One of those happens, and then it just makes everything else easier.
Yeah. Well,
Yeah.
yeah. You said earlier, like leaning into that, being curious, taking a risk, telling
Yeah.
a little bit about yourself, getting that connection. That's definitely valuable.
Yep. 100%.
Yeah. The human element.
Yeah. Correct. I think our entire global ecosystem, and this is how we think about it. Normally, if you think of like the triangle, everyone thinks the investor's at the top, and the companies have got to do so much work to get up there to win the investor. I think we try and turn it over
Hmm.
the other way. At the end of the day, the people that add the most value are the companies. You've got to be respectful to them, right? You've got
Yeah.
to be lucky that you've invested in a company. And if you get it wrong, that's your fault, right? At the end of the day, the company, the founder, the management team, the employees, they're busting a nut to win, to get right, to
Yeah.
create value. So I think the arrogance that sometimes exists globally with investors is kind of a little bit ugly, right? And I think I think the triangle's got to turn at some point.
Yeah, it's interesting because you brought up earlier about the sales aspect, about selling yourself to the company. Um, I guess how do you guys kind of go about that? Is it more like do you see most of the time where the investor's like, hey, we just want the capital, or do you see it more of the time where it's kind of more competitive, where you kind of need to sell yourself?
You definitely need to sell yourself a little bit, but if you sell yourself too much and it is competitive, then you will overpay, right? You've
Hmm.
got to have a barrier internally to say, I'm not going higher than this, right? So I will push a little bit because I really want to be involved. However, you've got to have that barrier, right? So you need to get to that point whereby the company's got to say, hey, these guys are price sensitive. We like them as people. We think they can add value. You've got to they've got to consider the opportunity cost. I think it's an opportunity cost both sides. Like for us, is it worth paying
Hmm.
that little bit more because we think we can get the return we want? And for a company, it's got to be, hey, these guys will add value. Let's discount it a little bit.
Yeah, makes sense. Obviously, you talked a lot about it now, how to enter into an opportunity or a deal. What about the exit point? How do you generate liquidity? How do you think about that?
Oh, it's hard as hell. Um, we we've been somewhat fortunate because it's in our DNA. So in that first fund we had, it was 7 years old. We had 37 exits. We're thinking about exits as soon as we enter, which is not a very nice thing sometimes, but internally we do think about it. And we are transparent in sharing that with companies as well, right? So we will say to companies, we are not a forever investor. We will be someone that goes on the journey for you, oh, sorry, with you, for you for 3, 5, maybe 6 years. But we want to be able to recycle the capital at that some point in time. You've got to do it somewhat respectfully. Now, as it turns out, if a business hasn't done well, bad luck. You're not going to get the exit. But if a business has done well, there's always another investor that wants to go on that next leg. So you've got to
Hmm.
work hard with the company, with the management, if there's an independent advisor, to get out. Right. So we've had situations where a business is doing well and there's a primary capital raise that's happening. We will then tag along and say, hey guys, we've had a great journey. It's been 4 years. We'll sell our secondary at a 15-20% discount to your primary raise if you would like that. And if for the new investor, they're reducing their entry price. Right. So that has worked very effectively for us. Conversely, if you've lost conviction in a position after say 1 year or 2 years, and there is a primary raise that happens at the same price as what you enter at, again, we'll say we'll sell ours at a 30% discount, which is lower than what we entered. But if conviction's lost, you've got to move on from it. And I think part of the genesis for why we do this is, one of my partners in particular, he was a very successful sales trader at Morgan Stanley, and this is how he's taught us to operate. Even though in private markets it's very hard to exit, you can use the psychology of public markets in private markets occasionally. So we do it, not constantly, but we do it occasionally. The other thing that is important as part of that process is continuing to talk to the board. Like, the board can be very influential. We're always discussing it with them. Sometimes they're like, "Oh, these guys at Alium, they're a bit edgy, racy. They're looking to get out." But if you've been honest, open, and transparent with them, and it happens after 18 months, we didn't lie to you. Right? We told you we wanted to move on. You've created the opportunity for us to move on, which is great. And then the final thing is finding an independent advisor does help. So if you remunerate them with a 3, 4, 5% fee to sell our position, they work damn hard. So they work on behalf of management and us, the seller, to find someone, right? As I said earlier, the supply demand equation's enormous, right? There's so many companies, but there's also so many investors, right? So the investors span from funds like us, venture, private equity, family office, institutional, all kinds of community sets. So an independent advisor is very helpful towards getting the exit should you need it.
Yeah, that's interesting. So these independent advisors that you guys work with. They'll look for other private equity firms that are looking to make an investment.
Correct. And there's plenty of them. So one thing that occurred post GFC, and more notably in the last 5 years, in and around COVID, is a lot of people left the big banks. Like, a lot of people, leave Goldman, Morgan Stanley, Credit Suisse, UBS, all these big names, and set up independent consultancies. And I'm sure it's like this in the US as well, but they flourished in Australia and in New Zealand and in Asia Pacific generally, and they're hungry for deals. Right? Whereas if you go to the big banks, they've got big deals they need to work on. They're not going to work on a small deal that Allium's coming to them with.
Makes sense. And you've also brought up boards a couple times. Talk to us about kind of how you think about boards with the companies you guys work with.
Our intention generally is not to be or get on a board. We want boards to be established. If a company is taking our money, part of the requirement and precondition is you've got to have a board established within a certain number of months or quarters. So it's important because of governance, right? Governance, budgeting, strategy, direction. So we like to see ones that are already established and in place, and it can't just be a group of insiders, and you can't have just investors on there, right? So we want to be able to see that these boards have genuine and true independence. Sometimes we will step on. So one of my other partners, Jason, and myself, we do sit on a couple of boards, and that will be because there's something that we want to drive, or something's occurred whereby we think we need to be involved, and that can relate to our position size. So if we own more than 25%, we're influential. So we will take a board seat because we have it, or we will then get someone that we believe, trust, know, and put them on. So it is important. Yeah. And sometimes, as both of you will know and your listeners know as well, it's critical for the CEO and the founder to have lots of people that they can trust and rely on, and the board's the best generally.
Yeah. What's you mentioned interaction with the board. What level of interaction or communication do you like to see as an investor if you're not obviously on the board?
We like quarterly at a minimum. But given what I was talking about probably 10 minutes ago around the relationship, we also have a WhatsApp with every CEO, founder, co-founders, management team or board, which are pretty active. So they will often exist even when we're not on the board. If we are on the board or have an observer, they're pinging constantly. But if we're not, we still want to have that dialogue. And I find that the frequency at a minimum is quarterly, but more often it's like intra-week.
Yeah.
Because no one wants surprises. You don't want a surprise, right? No one wants a surprise. And, they're very good at saying, hey, we're bidding for this particular contract. They keep you updated week 1, week 2, week 3, and then week 4, they'll go, we lost out to XYZ, right? So when you get the reported board papers, a quarter out. There's no surprise, and
Yeah,
that's important.
that makes sense.
That's a good point. Talk about the unique opportunities and challenges that you see in Australia.
So the opportunity is that this country has historically grown based on resources. So mining has been a big part of the economy, whether you're
Hmm.
selling steel, coal, copper, or rare earths globally. That's driven this country, and a lot of it's gone to either China, Japan, or the US, and increasingly now India. The government tactically, probably 20 years ago, said we want to be a knowledge economy. So they started to push STEM very early at school, in universities, government grants, incentives for technology companies to flourish. Some of you will know this, but some of the greatest inventions in technology have come out of Australia, right? So number like Google Maps. Google Maps is out of Australia. We're using it. Everyone's using it, right? Globally.
Hmm.
Wi-Fi is an Australian invention, right? Um, you've got amazing companies like Atlassian, which is used by every global technology company and corporate generally with Jira and Trello, etc. You've got this amazing ecosystem that's got government support. You've got students that work at corporate that spin out and build these companies and do a great job. So I think the opportunity's got this great tailwind, but that technology tailwind exists globally, right? Every country is now knowledge economy. Um, we're a small country. It's 30 million. I think in a technology context, we push way above our weight. There's great technologists that work in great companies like Microsoft, Apple, etc. So I think that's not going to slow down. I think a couple of the challenges that exist is the tyranny of distance, right? So
Hmm.
our time zone is challenging for North America. It's challenging for Europe. However, everyone knows that. Everyone makes it work. And one key anecdote here is taking New Zealand, right? So New Zealand's a small country. Every New Zealand technology company doesn't think about their domestic market. They automatically go, how do we get to the US? Right? So the default that everyone has is, what do we do to get Europe and North America right? And that poses a challenge at times because to grow in North America or Europe, you need a salesperson, you need a sales team, you need to have customer success, and that can be really expensive because you're democratizing the team. But if you're democratizing the
Hmm.
team in different geographies, you're going global, right? So the challenge is to get the timing of that right to ensure that customers want your product and you're growing parallel.
Yeah, makes sense. And yeah, time zone. I could definitely see that being a challenge.
Yeah.
The kind of last thing I was thinking about with the, in terms of like venture capital and the private markets, how has the higher interest rate environment affected you guys?
Higher interest rate environments are challenging for everyone, but I think it is kind of reflected in the discount rate that people apply and the price that they pay. So those astronomical growth rates and crazy prices in a low interest environment a couple of years ago was kind of like expected. That's what happens. That's euphoric. Interest rates can't be at zero, right? They just can't be. There is a cost of capital. So where they are now might be slightly higher than normal, and maybe we get to that 2 to 3% rate that everyone wants. But you've got to adjust your valuation expectations accordingly. It has become tough for companies to raise capital in the slightly higher interest rate environment, but that equally has meant for investors like us, raising capital is hard as well because you're competing against private credit and what you get in a bank. So I think the last 18 to 24 months have been challenging across the ecosystem. But we've had one rate cut here, which occurred last quarter. Yesterday they did not cut rates, but there's an expectation that they will over the balance of calendar 2025. But much is dictated by what Mr. Trump does around tariffs and what it means for economic growth, and does the US go into recession? Because that will have a significant impact on the interest rate outlook.
Yeah.
Yeah. So, Raj, based on kind of where you sit locally in Australia, Asia Pacific, is that what are some interesting things you're seeing there, or is that a topic of conversation that comes up on your side?
It comes up constantly, Skylar. I mean, China has been the engine for production and manufacturing for decades now. There has been increasing discussion around India and its knowledge economy and the back office for the world. But you're seeing a situation now whereby that economy, talking about India, domestic growth is just extraordinary. The equity market there has been very strong. There's a lot of technology that exists. So both China and India together, and then when you combine it with Southeast Asia, so Singapore, Malaysia, Indonesia, Philippines, these are monstrous economies. But the challenge is they're not homogenous. And that becomes the difficulty. So there's not one business that spans across all those countries. So you have to treat them as effectively three different geographies. And I'm not putting Japan into that bucket. We don't invest in those regions today, but many of our companies that we invest in sell product, be it technology or e-commerce products, or source from there as well. It's not going to slow down. It'll just become stronger. I suspect that out of Australia, given proximity, European and North American funds will probably end up having offices in this particular time zone. Now, whether that means Hong Kong, Singapore, or Sydney or Melbourne, I think that does increase over time. And we've seen some of the large European private equity funds have set up regional offices out of Australia, because you get the benefit of everything Western, but you can invest in everything Eastern.
Yeah, interesting aspect.
Mm-hmm. Yeah, definitely.
Raj, this has been a pleasure. Really appreciate you joining us in the podcast. Where could people go to connect with you and learn more about your company?
We're at www.aliumcap.com. We've also got a LinkedIn page. If anyone's interested in connecting with me, I'm willing to connect with you on LinkedIn. And if anyone's interested in investing in our new fund, which is the Alium Innovation Fund, we would welcome any discussions. Just to give you an idea of us, our first fund was a shy of $400 million fund. We did a net annual 22% IRR, 37 exits, 3 times people's money. And that was a good environment for part of it, tough environment for the balance. I think this vintage that we are investing within this new fund can probably do better than that. So connect with me if you're interested.
Amazing. Well, we appreciate the time, Raj, and we'll make sure to include all your contact info in the show notes.